Well, hello Internet, and welcome to part 9 of my Python for Finance video tutorial series. In this part of the tutorial, we're going to really focus in. We have made efficient, optimized portfolios, and now we're going to start analyzing those portfolios to see if they are up to snuff. We're going to learn about alpha, how to calculate it, how to calculate beta, and we're also going to talk about the capital asset pricing model and a whole bunch more. And I have a lot to do, so let's get into it. As you can see here, much of the same stuff as we had before already pre-built, but what we're going to be doing now is getting into calculating beta. Like I said, we're going to be going over all these formulas, what they mean. We're going to have to get S&P 500 data to compare against our portfolio to calculate beta and alpha. We're going to be updating daily returns. We're going to be finding the beta for our portfolio versus the S&P 500, talking about the capital asset pricing model, the Sharpe Ratio, and then calculating return on investment. And then we will also go and create this massive data frame with all of our different investments, the different totals for all of that, the daily return for our portfolio, which we will then use to automatically calculate all of this awesome data and find out that our portfolio outperformed the S&P 500 by 26.74%. All right, so we are going to be covering a lot. Of course, all this code is available in the description, and that's on GitHub. Everything's free. So everything here is exactly the same as what we've used before. The only thing is if you're on Windows or on Mac, you're going to have to change the path to wherever your stocks are, and I also have a link to the stocks in the description. So just a bunch of functions that we need that I have covered previously. I'm not going to retype all these in, of course. And if you missed any of the previous videos, you almost definitely should watch them. Otherwise, you will be massively confused. Now, the only thing I did here inside of merge data frame by column name, I changed this little bit right here. Because very often, for some reason or another, your data gets corrupted and you end up getting duplicate rows. So what this code does right here is it gets rid of those duplicate rows for you. All right? And then we can come in here. Let's just go in, and I want to demonstrate merge data frame by column name. So let's say we have a portfolio list, and it has 2 securities inside of it. I'm just going to pick some random securities like this. Well, what we can do is go and create my multiple data frame, and I can call merge data frame by column name. And what I'm interested in getting information-wise is the daily return from both of these securities. And I can provide a date. So let's say I want to go from 2018, the very first trading day, the whole way to 2021, 09-10. And I am going to pass in our portfolio list like that. And then I can just go and output this. Whoops, I actually have to run all this code. Be back in a second. And there you can see are the daily returns for both of these securities. Very, very useful skill to be able to go and pull data from multiple different data frames and utilize it. And that brings us to calculating beta. Now, what beta does is it provides the relationship between an investment and the overall market. Because like I said, our goal here is we created portfolios. Now what we want to do is test to see if they are performing better than the market itself. If the market's performing better than us, we might as well just buy an index fund. But that's what beta is going to tell us, and alpha and all these other things we're going to cover. Now, risky investments tend to fall further during bad times, but of course, they tend to also rise more dramatically during good times. And beta is found by dividing the covariance, which I talked about previously numerous times, of the stock and the market by the variance of the overall market. And it's a measure of systematic risk that can't be diversified away, if you don't remember. So if you have a beta equal to 0, that means there's no relation to the market. Less than, that means it is less risky than the market. And if it's greater than, that means it's more risky than the market. Okay? And just to provide an example, Albertsons, for example, is a grocery store chain. It has what is considered a low beta of 0.5. And the reason why is it doesn't matter what the economy is doing. Albertsons tends to do the same because if the economy is bad or good, people still need to get food and pharmaceuticals. So that's why Albertsons has a low beta. AMD, however, manufactures microchips, and it is considered a higher beta stock of 1.4. And this is because during hard times, there's less demand for their products. All right, so what I want to do here, I have a ton of stock data, but I don't have any information on the S&P 500. So what I'm going to do is show you how to download all that stuff and put it in a form that is going to be useful. All right, so I'm going to go SPDF, and this is going to be a data frame that is going to have the adjusted close data for the S&P 500. So I'm going to say pd.dataframe, and there you are. Okay, so I need to download all of my S&P data into my data frame. So I'm going to go and call web.datareader, and the ticker symbol for the S&P 500 is this guy right here. Okay, and then I need to designate that I'm downloading this information from Yahoo. And I'm going to say that I want 2017 1 and 3 through 2021-9-10. Okay? My one on my keyboard must be malfunctioning. Okay, so I got that. All right. So this is what I want, and specifically what I'm interested in is the adjusted close data for the S&P 500. Now I can also come in and get AMD's information, but in this situation I can just go get DF from CSV and AMD like that. And if I would go AMD underscore data frame like that, you could see that I am getting all of that information right there. Likewise, if I would come in, let's just come down here, and I'm going to go SPDF and get data frame from CSV. See how much easier it is? This is building off of numerous tutorials. We were able to do ridiculously complicated things now rather easily. So, and I'm going to go and get my S&P 500 data also. And now I'm going to do the same thing for the S&P 500. I am going to say save data frame to CSV and SPDF, and again with our ticker, so GSPC like that. Then I'm going to get the data frame from the CSV file, so 2 like that is equal to get data frame from CSV, and again throw in the same ticker symbol that we have right here. So let's get that out of there, paste that inside of there. Okay, and then what I want to do is I want to add my daily return to that data frame. So to do this, I say add daily return to data frame like this, SP and DF2 and the ticker symbol, and then I can go SPDF2 like this and run it. And I just realized I actually write all of this code in Windows because that's my main data science operating system. I just realized that if you put these caret symbols in here, that it causes an error on Macintosh. So you cannot use those on Macintosh. All right, so get rid of them, and on Windows you can. So I don't know why, just being difficult, I guess. Okay, so now we got all of that information on the S&P 500. So let's continue on. We already added the daily return and saved to my comma separated value file. And now what I want to do is I want to create a function that is going to find beta. And that is comparing this security to the S&P 500 data. So I am going to start off by going portfolio list is equal to, and I am going to put in my GSPC, that is the S&P 500, remember? And put quotes around that, of course. And then I'm going to say portfolio list and append, and it's going to append to this list whatever ticker is passed inside of here that we want the beta for. I'm going to go mult DataFrame, and I'm going to call again merge DataFrame by column name, and I'm going to specifically look at daily return, and also I am going to go 2018 January the 2nd, like this. That is the first trading day of 2018 through 2021 09 and 10, which is the last date I have information for. And I'll say I will pass in my portfolio list. All right, so there we got our new data frame. Well, we can go and I want to get the covariance. And to do this, we just go mult DataFrame dot covariance, and I'm going to multiply this times 252, the average number of trading days in a year. And I'll just worry about that later. You can go, and if you want to see what that looks like, go get it. Okay, and then what I want to do is I want to get covariance versus the market, and this is the covariance of the stock and the market is equal to covariance, and I'm going to go 0 and 1 like that. And then I want to get the annualized variance of the S&P. So I'm going to call this S&P variance equal to mult DataFrame. And what we're interested in here is GSPC and dot variance and times, outside of here, times 252 again. And then beta is going to be equal to the covariance versus market divided by the S&P 500 variance, and it will return the beta. So there it is, and there it is. And let's move that over there. Now, if I want to get the stock beta, all I do is I go AMD and beta, and just understand that this is going to be off slightly because beta is normally calculated over a 5-year period. And, you know, things have been a little bit volatile if you haven't noticed. And you can see that AMD's beta comes back as 1.409. All right? And that brings us to the capital asset pricing model. More on beta later. We're going to be calculating beta for entire portfolios. Okay, so we talked about Sharpe previously. Well, Sharpe continued to create what is called the capital asset pricing model based off the research of Markowitz, which we covered in the last 2 videos. And it focuses on investments in stocks and bonds. And with it, what we're going to be able to do is more exactly create portfolios that match a risk that an investor is willing to assume. And I'm not going to read all this to you, but basically what we are doing here is we are finding the risk, the variance of a portfolio, and how dramatically it could increase or decrease over a certain period of time. That would be considered the overall risk of the portfolio. And what Sharpe continued to find out is, well, let's say the portfolio could lose 15%. And the customer says, well, I'm only willing to lose 10. Well, what you could do then is continue adding very safe, risk-free investments to bring down that risk. And that's basically how it works. So, all right. So what I want to do here is I want to calculate AMD's expected return. And how I'm going to do this is I'm going to create a, wait a minute, I think I have risk-free rate up here. Don't I have a risk-free rate? Yeah, risk-free rate is right there. So I'm just going to copy this and then come way back down here again. So here we are. So if I want to get our return on investment or expected return, I just can go and get my risk-free rate plus, and then call find beta and pass in AMD right like that times 0.05 like that and RI like that. And you can see that it comes back to 8% or 8.29%. Actually, I should get this data right here and rip it out of there and put it back where it went. I accidentally put it in the wrong place. All right, so throw it down here instead, and there you can see you got the same thing. Okay, we also have been talking about the Sharpe ratio. And as I said before, William Sharpe created the Sharpe ratio to find the portfolio that provides the best return at the lowest amount of risk. So let's come in here and let's calculate. Here's the formula for the Sharpe ratio, which I covered previously. Let's say I want to come in and I want to find the Sharpe ratio just for AMD. So I can go AMD and Sharpe like this. Well, you just say like that, RI minus the risk, whoops, don't want to do that, risk-free rate like that, and then divide by, this isn't really going to have any real meaning, I'm just doing it just to show you that I can do it, and call AMD dot standard deviation and times 252 to the power of 0.15. All right, just formulas that we're doing. AMD and Sharpe like that, and there we go. So there is our Sharpe ratio for AMD. It's going to be more interesting, though, to be able to get this for entire portfolios, so that's what I'm going to really focus on. Now, another thing I want to do is I want to be able to get stock prices at specific dates. So I can just go get prices on date, and you're going to pass in a stocks data frame, and you're going to pass in a date that you want information for. And what we can just simply do is say return stocks data frame dot LOC, and inside of here just go PD and date time index, and we're referencing the dates, which every single price has a date inside of here. And then what we can do is just say adjusted close like that. And then if we specifically just want a value at a specific time, you put item right there. Okay, let's move on. Now what I want to do is I want to advance beyond that, and I want to be able to get a portfolio value by date. And how we're going to be able to do this, I'm going to call this get port value. And this is going to be not individual securities. It's going to be a portfolio of securities with different shares of the different securities. Okay, so it's a little bit more complicated. Well, we're going to say what date do we want, how many shares of each of the securities, that's going to be a list, and what are going to be the tickers. And the share list is going to line up with the ticker list so that we know how many of each of the ticker or each of the shares to buy. All right, very first thing I'm going to do, I'm going to go port prices, and I'm going to call merge data frame by column name like this. And I'm interested in adjusted close like that. And I'm going to pass in my date. And since I only want one date, I can keep the dates exactly the same, and it'll get me just a specific day. And I will pass in my portfolio list. Now what I need to do is I want to come in here and convert from a data frame to a regular old Python list. So to do that, I'm going to say port prices is equal to port prices, prices dot values dot to list like that. All right, got that all set up. And there's a trick to convert. Whenever you run this to list, it actually puts a list inside of a list. And what we want is just a list. So we want to break that list out of the list it's in, if that makes any sense. So I'm going to call this port prices again, because that's all that matters. And then what you do is just go sum and port prices like this with a array inside of there like that. All right, so now what do I need to do? Well, I need to create a list of values by multiplying the shares for each of the securities by whatever the price is. And I'm going to call this value list. All right, like that. And then I can just say for price and share in, and we can say zip port prices and shares. Okay, so the portfolio prices, and which is a list, and the number of shares for each of those guys. Well, what we want to do in this situation is go and append those to our value list. So we can say appends, and what we are appending is the price per share times the number of shares. And that's going to give us that total amount. And then what we can do is return the sum of all the securities all together just by calling value list. All right, so there you go. Not that many lines of code, but that thing does a lot of stuff. All right, so what we want to do now is, since we have all these awesome functions we created, what we want to do is get the value of the portfolio at the beginning as well as the end of the year. These are the securities. These are the number of shares of each of the securities. So I'm going to go port and value at the start, and to get it you just go get and port value by date like that, and I am going to say that I want to get that value at on the very first trading day of 2020, and there that is. And then I just pass inside of it the port shares and the port list like that. Okay, and it's going to be pretty easy to get all this awesome information. Then I probably would like to go and output this. I'm going to say portfolio value at start of 2020. That, and $, and I'm going to format this. I'm going to say 2.2f, and I am then going to go and output, of course, our portfolio at the start of that period. All right, and for the ending, I'm going to do almost exactly the same. So I'm just going to copy this. So we're going to get the value of our portfolio. This is the portfolio we made in the last video. So I'm just going to change this to end like that. This stays exactly the same. This part right here, well, the date changed. So I'm going to get the last trading day of 2020. And this stays the same. That stays the same. Value at the end of 2020. And portfolio, and change this to end as well. And if we run it, you can see that at the very beginning of 2020, we invested $11,738.29. And at the end of 2020, we nearly doubled our money. All right, so pretty nice return with our portfolio that we created in the last video, which is pretty neat stuff. Now what I want to do is I want to calculate return on investment. So to do so, I'm going to go ROI port is equal to, and I can just simply go port value at the end. Of course, I didn't almost double the money. I was sort of being a little silly there when I said that. If you're like, why? He's terrible at math. Okay. So what we do is we get the ending value minus the starting value. This is how we get return on investment. And we divide that by the portfolio value at the end of that term. And let's paste that inside of here. Let's utilize this guy right here. So what I want to do here is go portfolio ROI at end of 2020. And this stays the same. And what I need to do here is go and get the ROI port. So ROI port like that. And multiply that times 100 to get the percentage. And then I'm going to go and do the same thing and get the S&P 500 ROI to do a comparison between my portfolio and how well the S&P 500 did. So DataFrame from CSV And remember, this is GSPC like that. And I am going to go SP value start. Well, actually, you know what? I'm just going to, why do that? I'm going to get rid of that, and I'm going to get both of these guys right here. So I'm going to paste those inside of there, and I'm just going to change this to S&P value start, and I pass in SPDF. So SPDF. This stays the same, I believe. Yes, this is fine. And get prices. Whoops. Now I want to get prices on a specific date first. Whoops. I'm going to have to call a different function here, of course. So I'm going to go and call our other function we created, which is get prices on date. Isn't it awesome to always have exactly the function that you need? And the way that works is get prices on date. You pass in the data frame and then the date. So I just need to change this around a little bit. So let's go and let's get rid of this. And there's our data frame. And then you pass in the date. Get rid of that extra comma. All right. And what else do I want to do? Well, let's just move this down here. And let's do the same for the ending date. So copy, paste, and change this to end. And get prices on date. And we're going to get through 12/31, just like we did with our portfolio. All right, so we got the S&P start and end. Well, what am I going to do? Well, I need to get the ROI. I'm just going to get rid of this guy right here. So put that there, and I can get rid of this one also. All right, so I need to get the return on investment. So S&P ROI is going to be equal to the SP value at the end of the year minus SP value at the start of the year and divided by SP value at the end of the year. Then what I can do is I can say S&P 500, S&P, so S&P, return on investment at end of 2020. And there's this. And I just go S&P, get rid of that, S&P ROI. And I'm going to multiply it times 100 again. And I'm going to throw in double percent sign. So a percent sign shows up and another double percent sign. So that shows up. And there you can see our portfolio that we created had a, whoops, I don't want a dollar sign. So let's get rid of this guy. And let's get rid of that one. All right. Boom. So our portfolio that we crafted over the last couple videos in 2020 had almost a 40% return versus the S&P, which had a 13.26 return. Good return, much better return. All right, so now you can see the power of efficient portfolios. So now what I want to do is I want to be able to find the daily return for the entire portfolio. So this is going to be useful to make even more dramatic calculations. So I'm going to go and call this get port daily return. And I'm going to get the starting date. I'm going to get the ending date. I am going to get the number of shares and the tickers, just like I did previously. Need to know how many of each of the shares to get. So I'm then going to say mult DataFrame is equal to merge DataFrame by and column name. And I'm interested in the adjusted close price with, whoops, like that, starting date and ending date. And I can pass in our portfolio list that I created previously. You know, this guy right here. I'm going to pass in that security list, that portfolio list anyway. All right. Then I want to get the number of columns or the number of securities that I have in the portfolio. To do that, you go length, mult, df, dot, and call columns. All right. Then what I need to do is I need to multiply each stock column by the number of shares. So I'm going to go and create I is equal to 0. And then I'm going to go, while I is less than the number of columns, then I'm going to get mult DataFrame and tickers, and each individual ticker symbol is going to be put inside of this new data frame by name. That's where I'm getting that. Then I can go mult data frame and tickers and I and dot, and I can call apply and lambda x colon, and I'm going to multiply the value time for each of the individual securities by the number of shares for said securities. All right, so that's, I'm going to calculate that, and then I just need to increment the value of I. All right, now that I have all that, I can create a new column with the sum of all the stocks. So I'm going to go inside of this same exact guy right here and say I want a new column called total, and the value I want to put inside of it is going to be found by going ilock like this, and I am going to get all of the values for all of the columns for those guys, and I have to put a comma right there. All right, so that's going to add up all of those, and it's going to give me the total for all the different securities based off the number of shares that you have of each of the securities, and put it into a new column that is called total. All right, so then you go axis is equal to 1. All right, so now that I have the totals, what I want to do is add another column to this gigantic data frame that is going to have the daily return for our portfolio on every single day. So daily return, and you're going to be able to see how dramatically it fluctuates, or not, more than likely. So mult data frame, and I just call, or I get the total column, total, and put quotes around that, of course, like this. And I am going to be able to go and divide that by mult data frame, and I shift backwards from to the previous day's total, and that is how I'm able to get the daily return. Covered this also in a previous video, a couple times actually, I believe, and I just shift backwards by 1, and that is how I'm going to be able to get the different daily returns by comparing the previous total to the new total, and then creating a new data point called daily return. All right, so I got all that set. Our data frame here is ridiculously awesome, and it has every single thing we could ever want it to have. Now what it can do is I'm going to create total portfolio data frame, and I'm going to call get port daily return, and I'm going to start. I have a start date of 2020 and 01-02 and 2020-12-31, and I pass in, of course, the number of shares for each of the securities in our portfolio, as well as the portfolio list. And if I do that, I can say total port data frame, boom, and I must have made a little error here. And here is the bug. Get rid of this bracket right there, and also get rid of this one at the end right here. I think that fixed it. And let's come in and run it. And there you can see we have the different price changes for each of our securities depending upon the number of shares. And then at the end, we have the total value of our portfolio and the daily return. There's no daily return on the very first one. And you can see the daily returns for every single day. And you can also see the final values for our portfolios, each of the individual securities, and then the final portfolio also. All right. Now, with all of that information, we're going to be able to find the beta for our entire portfolio. So I'm going to create a function, and I'm going to say find and port and beta, And the awesome thing is you're going to be able to change your portfolios and then easily just call these functions, and it's automatically going to recalculate all of this stuff. That's the power of functions. Okay, so I'm going to create a data frame. And so data frame like this. And whoops, put that back up there. All right. And this is going to hold the data for the S&P and my portfolio of securities. I need to, of course, create a mask. So this is going to be the portfolio mask. I only want certain dates. So I'm going to say port data frame and index. We did this in a previous video also. So I want all the dates greater than or equal to the starting date. And I want, for my portfolio data frame, I want to get all of the data between these two dates. There's the ending date. All right, and that's how a mask works. Now I want to also get the S&P data frame. So I'm going to go S&P data frame is equal to, and I can call get df from CSV and pass in G, S, and P, and C, like that. And I need to also create a mask for the S&P 500. It's going to be exactly the same dates, and this is basically going to be the same. So I'm just going to copy and paste that inside of there. And all I need to do here in this situation is just change this to S&P DF. So S&P DF, that's the same, and this is S&P DF. All right. So I got my masks now. Now what I want to do is I want to add my S&P daily return to my data frame. So I'm going to go mult data frame and GSPC like that. And this is equal to S&P DF and location S&P. I use my mask to say what dates I want to pull the information from. And then I say specifically, I am interested in the daily return data for the S&P 500. All right, now I want to add my portfolio daily return also. So basically exactly the same, just copy this, paste this inside of here, change this to portfolio. So portfolio of securities. And in this situation, this changes to port DF. Location, port, this is going to be port mask. I'm going to use the other mask. And also daily return. And then I can go covariance is equal to mult df and covariance. And we can say times 252, number of days in a trading year, average anyway. And covariance versus the market. We are comparing our portfolio. We already know our portfolio is awesome. What we're mainly doing here is just verifying it. And we are also going to, we covered this later up in the video. And we're also going to see if there's any huge amount of risk for getting this awesome return that we already knew that we have. So mult DF, but guess what? Most of the time it doesn't work out this way. Most of the time everybody underperforms the stock market, not the other way around. So, and I'm just going to say variance and times 252, and then I can calculate beta. Beta is going to be equal to the covariance versus the market, like that, divided by the S&P 500 variance, and I can return the beta. Whoops, beta, like that. Boom. Okay, and there we go. Now, what I can do is, well, we're also going to calculate alpha. And alpha is going to provide the measure of how well a portfolio has performed versus the S&P, with also references to the risk-free rate. And the capital asset pricing model is going to assume an alpha of 0. And good portfolios have a positive alpha, while a bad one has a negative alpha. And this is how we calculate the alpha. R represents our portfolio's return. RF represents the risk-free rate, that 0.0125, minus whatever the beta is for your security, times RM, which is the market's return minus the risk-free rate. Okay? And that's how we find alpha. But I'm going to first get the beta, because I have to get that. to find alpha. So I'm going to say find port beta and pass in total port data frame like that, and 2020-01-02. That's the starting, oops, 02. Why can I not type 2? There we go. And through the end of 2020-12-31. All right, got that. Now what I want to do is go and output my beta for my securities, and there's an error. Let me fix it. Oh, I put date frame instead of data frame. So it's funny. Date frame, change that to data frame like that. Little typos get me all the time. Run it. And you can see here our portfolio beta comes back as 0.91. And now what we're going to be able to do is get our portfolio alpha. So I can say alpha, and what we do is return on investment of portfolio minus the risk-free rate. This is the formula that I just showed you above, minus the portfolio beta times the S&P's return on investment minus the risk-free rate. All right, that. And then what we could do is we can print that out. Let me just go and find somewhere where that happens so I don't have to type all this out. So let's just go copy this guy right here. And there you go, and paste that inside of here. And we can just say, change this to portfolio alpha, like that. And then we can go portfolio alpha times 100. So portfolio alpha times 100, like this, and run it. And you can see our portfolio alpha comes back as 26.74%. And what does that mean? That means our portfolio outperformed the S&P 500 in 2020 by 26.74%. Pretty doggone good. All right, guys. That is an insane amount of information. I don't know if anybody actually watched this to the end. If you did, I would be extremely grateful if you would take 5 seconds and say, I watched it to the end. That's all I want to see. And like always, please leave your questions and comments down below. Otherwise, till next time.